Ever feel like maybe you could use like a peek inside the mind of one of those Wall Street titans,
Mm-hmm.
just to kind of see what makes them tick?
Yeah,
Well, today we're doing exactly that.
that was good.
We're diving deep into Warren Buffett's 1991 letter to Berkshire Hathaway shareholders.
Ah,
This thing's practically Wall Street scripture.
it's true. This letter isn't just about numbers. It's really a masterclass in Buffett's investing philosophy, and it's full of this timeless wisdom that you can apply to almost any field.
And the best part is, Buffett is this legendary investor, but he explains things so clearly that you don't have to have a finance degree to understand him.
Right.
Well, it's like having a chat with your super smart friend who also happens to be a billionaire.
Exactly.
Yeah.
And he starts by addressing something that a lot of people might not expect. Berkshire's incredible growth in 1991.
Okay.
Pretty impressive, sure. But Buffett acknowledges that even he can't defy the law of large numbers forever.
Okay, so back up for a sec. Law of large numbers.
Mm-hmm.
What does that even mean, like, in this context?
Basically, as Berkshire Hathaway gets bigger, finding investments that can really move the needle, that gets harder.
Mm.
Imagine trying to make a splash in a swimming pool versus in the ocean.
Right.
That's the challenge that he's facing.
Oh, I see what you're saying, yeah.
Yeah.
So a huge win for tiny Berkshire in the early days
Right.
wouldn't even make a dent in the balance sheet now.
Exactly. Buffett actually throws out some numbers to illustrate this.
Okay.
Back then, a $1 million winning idea could boost their returns by 5%.
Okay.
Now they need a $370 million win to get the same result.
Wow. So how does a legendary investor, like, deal with that kind of pressure, He
Yeah.
must have felt it, right?
Oh, absolutely. But this is where his long-term focus comes in.
Okay.
He emphasizes that he's not after short-term stock pops.
Yeah.
He's aiming for consistent growth in Berkshire's intrinsic value.
Intrinsic value, that sounds like one of those Wall Street buzzwords.
Right.
What is that like in plain English?
Think of it like this. Imagine two cars. One is really flashy and expensive, but it loses value the minute you drive it off the lot.
Right.
The other one is more of a workhorse.
Yeah.
Not as glamorous, but it just keeps going reliably for years.
Mm-hmm.
Buffett's interested in those reliable workhorses, companies with solid foundations that will generate value over the long haul.
He's playing the long game. He's not trying to time the market or chase fads.
Exactly. And that's a powerful lesson for all of us, no matter what we do.
Yeah.
Whether we're building a career, a business, or even just working on a personal project, that long-term perspective can make all the difference.
It's like that saying, slow and steady wins the race.
Yeah,
But in Buffett's case, it's more like smart and steady wins the financial marathon.
right.
Speaking of smart and steady, we have to talk about Buffett's billion-dollar bet on a certain fizzy drink.
You mean his legendary love for Coca-Cola?
Yeah.
Isn't there some story about how much he drinks?
Oh, absolutely. He's open about his cherry Coke habit, even calling it an extreme example of putting your money where your mouth is in the letter.
I mean, who buys $1 billion worth of stock because they just love the product,
Right.
It's like the ultimate vote of confidence. It might seem a little eccentric, but it's a perfect example of Buffett's core strategy. Buy great companies and hold them.
Okay.
Coca-Cola is a global powerhouse with a brand that's recognized pretty much everywhere.
Mm-hmm.
It's like buying a share of the world's thirst.
So he finds these amazing companies, invests heavily, and then what?
Yeah.
Just sits back and lets them do their thing.
Pretty much. Buffett's like the coach of a winning sports team.
Yeah.
He doesn't need to micromanage every single play.
Right.
He finds the best players, puts them in a position to succeed, and trusts them to execute.
And speaking of having a lot on his plate, wasn't he also juggling another pretty big role at this time?
He was.
Interim chairman at Salomon Inc.
Yeah,
Talk about a side hustle.
it does sound like a lot, but it actually highlights something really crucial about Buffett's approach. He believes in building strong leadership teams.
Okay.
He even compares himself and his business partner, Charlie Munger, to football coaches who can trust their talented players to perform on the field.
I love that analogy. It shows that he's not afraid to delegate and empower the people he believes in. But even the best coaches face challenges.
Yeah.
And in the early 90s, one industry in particular was going through a massive upheaval.
Right.
Media.
Yeah.
Even back then, Buffett saw the writing on the wall.
This is where Buffett's foresight really shines through. He recognized that the media landscape was changing rapidly.
Yeah.
And he wasn't afraid to analyze those changes head on.
And he does this by making a distinction between two types of businesses, right?
Yeah.
Franchises and, well, everything else. Can you break that down for us? So franchises versus, like, regular businesses.
Right.
What makes a business a franchise in Buffett's book?
So to Buffett, a franchise isn't just any old business.
Okay.
It's a company with a product or service that's in high demand, has a serious edge over the competition.
Right.
And it's not bogged down by a ton of regulations.
Okay.
These businesses, they have real pricing power.
Okay.
They can raise prices without scaring away their loyal customers.
Okay, so think, like, I don't know, Apple.
Yeah.
People line up for their products. They're not exactly known for being cheap.
Exactly. Or think about your favorite brand of toothpaste.
Right.
You're probably not going to switch brands just because some competitor pops up with a slightly lower price.
It's the power of the brand, right?
No, right.
That loyalty factor.
Yeah.
Got it. So what about those other companies then?
Yeah.
The not franchises?
Right.
What makes them different?
So Buffett just calls those businesses
Okay.
because they lack those really durable competitive advantages.
Right.
They might be doing well, right now because they're the cheapest option.
Right.
Or because demand is temporarily high.
Okay. But
Their success is less certain.
exactly. Less predictable. Their earnings are more likely to bob around over time. And they're much more vulnerable to competition or, like, bad management decisions.
Okay, so back to the media landscape in the early 90s then.
Yeah.
Where did these media companies kind of fit into all this?
Yeah.
Were they franchises or just businesses?
That's the million-dollar question, right?
Right. And Buffett saw that the media landscape was shifting in a way that made even the big players more vulnerable.
Okay.
Consumers had more choices than ever before.
Right.
More channels, more publications.
Yeah. More ways to get your news and entertainment.
Exactly.
And more competition usually means
Lower profits.
Right.
And that's what worried Buffett.
Okay.
He realized that the media landscape was becoming less like a franchise and more like a regular business.
Right. And this is where he kind of admits he made a little bit of a misstep.
That's right. He's very upfront about the fact that he held on to some media investments longer than he should have.
Okay.
He even uses some simple math to show how the valuations of these companies had to change with this, shifting landscape.
It proves that even the Oracle of Omaha isn't always right.
Exactly. But here's the important thing.
Okay.
He doesn't just gloss over these mistakes.
Right.
He owns them, analyzes what went wrong,
Yeah.
and learns from them.
Yeah.
It's that humility and willingness to learn that makes him such a fascinating figure.
It makes you realize he's human,
He is.
just like the rest of us.
And speaking of human, you ready for a story about candy?
Oh, I'm always up for a candy story.
Circles.
Especially when it involves Warren Buffett.
Right.
Hit me with it.
This one involves See's Candies,
Okay.
the company behind those delicious chocolates.
Yes.
Buffett often jokes that he should have just bought See's and locked the doors,
Chuckle.
just funneling all the profits into his other investments.
Sounds like a pretty sweet deal to me. But wait, didn't he almost miss out on this whole thing? Didn't he lowball them on the offer initially?
He did. Back in 1971, See's Candies was up for sale for $30 million.
Okay.
Buffett and Munger, they saw the potential,
Yeah.
but they almost walked away because they were only willing to pay $25 million.
Wait, hold up. They were going to pass on a company they loved. A company they thought could print money.
Right.
Because of a $5 million difference.
It might seem crazy now.
Yeah.
But it shows just how disciplined they were, even back then.
Wow.
They were not going to overpay.
Wow.
Even for a company they believed in.
So what did they see in See's Candies that made them so sure it was a winner?
They recognized the power of the brand and, again, this loyal customer base.
Yeah.
Buffett often talks about this idea of consumer franchise, and See's is like a perfect example.
Right.
People loved those chocolates, and they were willing to pay a premium for them.
So even if they raised prices a little.
They'd still buy them.
Right.
That's pricing power in action. And that, my friend, is a key ingredient in what makes a business truly valuable.
Yeah, it's like that old saying, charge what you're worth.
Chuckles.
Right.
These, they clearly knew their worth.
They did. Now, it wasn't all smooth sailing.
Okay.
Remember how we were talking about Buffett's sense of humor?
Mm-hmm.
Well, he had this run-in with California lawmakers.
Okay.
Over a so-called snack tax that perfectly illustrates that side of him.
Oh, yeah, the great California snack tax debate. What was that all about? So California decided to implement a sales tax on, quote, snack foods, unquote.
Okay.
But their definition of what constituted a snack was a bit, well, inconsistent.
He actually includes this list, right?
He does.
In the letter,
Okay.
of the taxable snack foods versus the non-taxable non-snack foods.
Right.
It's hilarious. Ritz crackers were taxed, but soda crackers weren't.
Chuckle.
Popped popcorn, taxed. Unpopped popcorn, not taxed.
Classic Buffett.
Right.
Finding the humor in the absurdity of it all.
Yeah.
But beyond the jokes, it does highlight a really serious point.
Okay.
Even seemingly small details can have a real impact on a business.
And speaking of business, let's move on to how Buffett approaches buying an entire company.
Okay.
He lays out his criteria pretty clearly in this letter.
He does.
It's like a masterclass in smart decision-making.
It really is. He's essentially sharing his playbook.
Right.
But instead of football strategies,
Right.
it's all about identifying businesses with this, with this real lasting value.
So if you're thinking of buying a business, or even if you just want to understand how a brilliant mind approaches these kind of decisions, listen up. What are Buffett's must-haves for a potential acquisition? It's like he's giving us a checklist.
Exactly. And at the top of that checklist,
Okay.
he's looking for large companies
Okay.
with a proven track record
Right.
of solid earnings.
Okay.
None of that risky startup stuff for him.
Right.
He wants to see a history
Right.
of consistent profitability.
Makes sense.
Yeah.
So no get-rich-quick schemes.
Yes.
He's all about those companies with a solid foundation. Right.
What else is important to him?
He's also extremely wary of debt.
Okay.
He wants companies with as little debt as possible.
Okay.
Hates the idea of relying on borrowed money
Right.
to inflate returns. Too risky.
It's about minimizing risk,
Yeah,
playing it smart.
exactly. And just as important as the numbers
Okay.
is the leadership team.
Right.
Buffett looks for companies with strong,
Yeah.
experienced management already in place.
Again, like that coach analogy,
Exactly.
he wants to bring in the MVPs,
Right.
the all-stars,
Yeah.
who are already at the top of their game.
Exactly. He's looking for people who are passionate about their businesses,
Okay.
not someone he has to teach or micromanage.
Right.
And the business itself needs to be something he understands.
Buffett famously avoids companies with overly complex technologies
Right.
or convoluted business models.
He sticks to what he knows.
Yeah.
His circle of competence.
Absolutely.
Smart move.
And finally,
Yeah.
he wants straightforward deals.
Okay.
Tell him the price,
Yeah.
and let's get down to business.
Yeah. No drawn-out negotiations.
Right.
Or back and forth.
He's not afraid to walk away if it doesn't feel right.
He trusts his gut.
Exactly.
So if you've got a company that fits that description, give Warren a call. Oh, I have a feeling his phone is ringing off the hook already.
Probably. But there's a really important point in this letter
Okay.
where he addresses the folks who think they've got the next big stock tip.
Okay.
He basically says, don't call us, we'll call you.
He's not interested in those unsolicited stock picks.
Yep.
He believes in doing your own homework.
It goes back to his core philosophy.
Okay.
Focus on understanding a few superstar companies.
Right.
Rather than trying to chase every hot stock tip you hear.
Right. Depth over breadth.
Exactly.
So how do we apply that kind of thinking to our own lives?
Right.
Even if we're not in the business of buying and selling companies.
That's the beauty of it.
Yeah.
It's about thinking like an owner,
Okay.
not just an investor.
Right.
It's about looking beyond the stock ticker, the headlines,
Yeah.
and trying to understand the underlying businesses.
Right.
Do they have staying power?
Right.
Will they still be relevant 5, 10, 20 years from now?
It's about looking past the hype.
Yeah.
And understanding what creates lasting value.
Exactly. And that brings us to a concept that Buffett talks about in this letter.
Okay.
That can be a real game changer once you understand it.
Oh.
Look through earnings.
Okay, I have to admit, that sounds a little intimidating. Break it down for me.
Okay.
What are look-through earnings, and why should I care?
It's actually simpler than it sounds.
Okay.
Imagine you own stock in a company
Okay.
that uses a smaller company
Okay.
to supply a key ingredient for their product.
Okay.
Look through earnings means
Yeah.
you not only look at the profits of the company you've invested in,
Right.
but also the profits of that smaller supplier,
Okay.
because those profits ultimately impact your investment.
Oh, I see what you're saying.
Yeah.
So it's like seeing the whole ecosystem,
Exactly.
the interconnectedness of it all.
Precisely. It's about looking beyond just one level to understand how value flows through the whole system.
Okay, that makes sense.
Buffett uses a great analogy from the world of baseball to illustrate this.
Okay.
He says, in investing, just as in baseball, to put runs on the scoreboard, one must watch the playing field, not the scoreboard.
Don't just focus on the score. Focus on the plays that got them there.
Yes. Don't get so caught up in the day-to-day stock fluctuations
Right.
that you lose sight of the underlying businesses
Right.
and how they're actually performing.
It's about focusing on the long game, the fundamentals.
Exactly.
Wow, we've covered a lot of ground today.
We have.
From the law of large numbers to intrinsic value, from the importance of strong leadership to the power of pricing.
Yeah.
Warren Buffett's 1991 letter to Berkshire Hathaway shareholders.
It's a good one.
It's more than just a financial document.
Right.
It's like a masterclass in smart decision-making,
It is.
long-term thinking, and understanding what truly creates value.
And you know what I find most inspiring?
What's that?
Is that his wisdom applies to so much more than just investing or business.
Right.
It's relevant to our careers, our relationships,
Yeah.
even just how we approach our everyday lives.
It's about focusing on what matters,
Yeah.
tuning out the noise,
Right.
and making choices that lead to long-term success and fulfillment.
I like it.
And on that note, we'll leave you with this final thought.
Okay.
Inspired by Buffett's concept of look-through earnings.
Okay.
Take a look around at your own life. The things you own, the
Hmm.
things you spend your time on, the
Yeah.
people you surround yourself with. Are they contributing to your look-through earnings?
Ooh, I like that.
Are they helping you build something of lasting value?
It's a good question.
It's a question that can lead to some surprising insights
Right.
and maybe even some life-changing decisions.
You could.
Until next time, keep diving deep.